We are living in a weird economy where the average American is struggling to buy groceries, but the stock market keeps soaring. Well, we just got an interesting warning from a couple of the biggest names that you hear about on Wall Street. The first is from Bridgewater Associates, which is the largest hedge fund in the world, where their CEO just came out and said that an economic slowdown is coming and investors should start preparing. I'm going to dive deeper into what he said in just a moment, but the second company that I want to talk about isn't a bank on Wall Street, but it's a company that's talked about a lot on Wall Street. McDonald's. And what the CEO of McDonald's said is Americans can't afford their burgers anymore, so now they're trying to find new ways not to break your bank. So now when we take a look at these two statements, one by Bridgewater Associates, which is your traditional Wall Street firm, and then you have McDonald's, which is, we'll call it the American company, not saying that this is a representation of America or anything, but because a lot of people in the world and America eat at McDonald's. I want to dive deeper into both of these two things, and the reason why this comes at an interesting time is because we also just got a statement saying that consumer spending is finally starting to slow down. So if you're an investor or you've been thinking about investing your money in the markets, I want you to stick with me until the end of this video because I think you're going to get a ton of value out of this. And I'm going to start by talking about Bridgewater, then I'm going to go over McDonald's, then I'm going to put it all together with you. So let's start by talking about Bridgewater, but before we do, a quick reminder that on May 21st, right around the corner, I'm hosting a stock market investing workshop. I'm going to be going over my own stock market investing strategies. So whether you have a 401k, an IRA, or you're investing your money yourself, if you want to see different ways that you can invest, especially in the strange economy, it's a free workshop. I will have a live Q&A in the end. So if you'd like to join me on this workshop, all you got to do is register, and I got the link for you down in the description below. Let me start this video off by just reading you a quote from the Bridgewater CEO. Make sure you're building a resilient portfolio, which you really didn't quite need in the previous decade, but you will need it in the next decade. Now, for those of you who are unfamiliar with what Bridgewater Associates is a hedge fund that manages other people's money. They are the largest hedge fund in the world. They were founded by a guy named Ray Dalio. Ray Dalio is kind of a celebrity now, and he's been all over different podcasts and news, and he has an amazing book called Principles. Well, it's a series of books. I highly recommend that book. But what Bridgewater did is they innovated the way that they invest money, and they've been able to get very good returns over the last number of years. And what the CEO of Bridgewater is saying now is that the next 10 years or 15 years of the economy might not be like the last 15 years. Take a look. When you look at the last 15 years, the stars have aligned for investors. It's been a tremendous period. 15 years ago was 2009, and obviously 2009 was a very different period in our economy because that was kind of the tail end of the 2008 crash. The economy was just coming out of a recession, the stock market was coming out of a very down period, and the real estate market was still getting smacked very hard. But if you take a look at what has happened over the last 15 years, wages over the last 15 years have gone up by around 65%. By the way, this is from usafacts.org, but at the same time, housing prices around the country, median home prices have grown by around 200%. Now, it's hard to say how much home prices have really gone up over the last 15 years because real estate is very localized. Like housing prices in Miami have changed differently than housing prices in Detroit. So take that with a grain of salt, but in general, you can get an idea that home prices around the country have gone up by a lot, a couple 100% by average around the United States. But at the same time, the S&P 500, the stock market index, has grown by around 500% over the last 15 years. Now, what does this show you? You start to see a discrepancy. Incomes have risen, but wealth from investments have risen even faster. But let's keep going. He goes on to say that we had a blip in investment values during COVID. We got a hit, but then a lot of liquidity happened. We got flooded again, fiscal monetary jubilees, and it's pretty incredible. So between 2009 till around 2020, markets are growing, assets are growing, but then came the pandemic. And during this pandemic, it was supposedly the worst recession since the Great Depression. The economy shut down, people are getting laid off, but then the United States government works to pass multiple stimulus programs worth around $5 trillion. Where did this $5 trillion come from? Well, the Federal Reserve Bank printed this $5 trillion out of thin air. They gave it to the United States government, and the government gave this money out to the economy. They gave it to people in the form of stimulus checks. They gave it to people in the form of unemployment checks. They gave it to businesses in the form of grants. They gave it to businesses in the form of PPP loans. They gave it to businesses in the form of bailouts. So this money now enters the economy, and it stimulates the economy, And now we saw another boom in the stock market. We saw another boom in asset prices. So if we take a look at now how things have changed between 2019 and 2024 over the last 5 years, wages have grown by around 22%. Now I got this number from the Social Security Administration, looking at the cost of living adjustments. But at the same time, we've seen housing prices grow by around 50%. Again, this is not an exact number. It varies neighborhood to neighborhood, state to state, but it gives you an idea of how much home prices have grown over the last 5 or so years. But at the same time, the S&P 500 has grown by around 80% over those last 5 years, which means investors made a windfall. All this money printing that happened during the 2020 pandemic benefited asset owners, it benefited investors, while the average worker, maybe you got a little raise, but for the average worker, that little raise wasn't even enough to keep up with the higher cost of groceries. But the question is, what does that actually mean, and where does that mean we are now? Asset prices are a lot higher, and interest rates are a lot higher in a way that there's a hurdle rate for investors to make decisions. What that means is today we have investment values that are a whole lot higher than they were 5 years ago, and they're a whole lot higher than they were 15 years ago, which by itself might not be a big deal. But in addition to that, we also have these significantly higher interest rates, which pose some hurdles for investors. What is that hurdle? Well, if you're an investor and you have to borrow money to make investments, you're borrowing money at significantly higher interest rates today than what they were a few years ago or even 10 years ago. And so now, if you have to pay more money to borrow this money, that means you have to get even higher returns in order to justify making an investment. Like if you're going to go buy an apartment complex and you have to pay 8% on your mortgage, your return has to be at least 8% to justify making that investment. The problem is asset prices, real estate prices, stock prices have gone up so much that getting those higher returns is very difficult. In fact, what has happened for a lot of assets is that potential returns have shrunk, which makes it less attractive. And then on top of that, you have to pay the higher interest rates. And this is where the CEO of Bridgewater gives you a little piece of cautionary advice. Just don't assume that the next decade is going to be just like the last one. The last decade was interesting because after the 2008 crash, we had a lot of stimulus. We had low interest rates that came in, and then we had a lot of money printing that came in, which was good for investors. It was good to stimulate the economy, but it created some inflationary issues, even though we never really saw the impacts of inflation. Well, we did the same thing in 2020. We cut interest rates, we did a lot of stimulus, but this now created the inflationary issues. And that's why he's saying that now, in order to combat this, don't expect the same past in the future. Take a look. The United States, I believe, in order to slow down inflation, will need actually restrictive policy. The reality is, to bring inflation down, you have to slow the economy. Now, to explain what Wall Street terminology means to regular English, restrictive policy means higher interest rates. And this is what he's kind of hinting at is, we might need higher interest rates in order to actually bring inflation down to 2%. And in order for that to happen, the consequence is a cooling economy. So what he's saying is, if the goal is actually to bring inflation down to 2%, you got to understand that there are consequences. And those consequences include even higher interest rates than what we have today. And that means a slower economy, higher unemployment, and more pain to people. But now let's shift gears a little bit and talk about what McDonald's is saying. McDonald's is a public company. That means that you can buy shares of the McDonald's stock on the stock market. And one of the benefits of McDonald's being a public company is that they have to report every quarter their earnings. They have to talk about how much money they make. They have to talk about their profits. And they have to talk about their concerns and projections about the future. And what the CEO of McDonald's said on their most recent earnings call is that low-income Americans can no longer afford a burger and fries. That customers making $45,000 a year or less have decreased in the most recent quarter. Now, for those of you who are old enough to remember, which you really don't need to be that old to remember, McDonald's used to have a dollar menu, which obviously they don't anymore. I don't eat at McDonald's, so I don't even know that they got rid of a dollar menu, but they don't have a dollar menu. But what McDonald's has seen recently is that people don't have money to afford however expensive their burgers are because they had to raise the prices of the burgers because of inflation. And this is where now McDonald's has been facing this impact that their low-income customers, which you have to imagine are a big chunk of the customer base at McDonald's, they can't keep affording their more expensive burgers and fries. And this is where McDonald's has been working kind of strategically to find a new value menu. Not a dollar menu, but a value menu to attract these low-income customers to come back and say, you know what? I can actually afford McDonald's again. Now, this is not an advertisement for McDonald's, but let me show you what the $5 value menu is. That way you can see where I'm trying to go with this. The $5 value menu at McDonald's gives you a McChicken or a McDouble, a 4-piece chicken nuggets, and fries and a drink. But here's the interesting part. The goal of McDonald's creating this $5 value menu promotion is to bring the lower income customers back to McDonald's so they can keep affording this purchase. But what McDonald's said is essentially, they might not be able to actually afford this value menu promotion. And it's not just that. In order to help fund this $5 value menu, they had to work with Coca-Cola to subsidize this $5 value menu because Coca-Cola is helping to pay McDonald's to do this promotion. That way they can start getting their customers back. Coca-Cola said that we routinely partner with our customers on marketing programs to meet consumer needs. Now obviously Coca-Cola would get the benefit. The customers would buy a Coca-Cola along with their burger. But you can start to see the issues that if people are struggling to buy McDonald's, there's got to be some issue there, right? Because McDonald's is known as the discount burger. Take a look at what the CEO of McDonald's said about that. Consumers continue to be even more discriminating with every dollar they spend as they faced elevated prices in their day-to-day spending. So now I want to put this together because Bridgewater and McDonald's are very different companies, but they're both very well known on Wall Street. Bridgewater works with high net worth people and they invest their money into companies. And the CEO of Bridgewater is saying that they're anticipating changes in the economy in the next decade to meet the demands of high inflation, to meet the demands of the higher interest rates. So that's what they're thinking about. McDonald's, on the other hand, is working directly with average people, lower income people. And what they're saying is lower income people are struggling to buy our stuff. And not just that, McDonald's is struggling to find ways to offer discounted things. Not a dollar menu, but these value menus. And that's what they're working on. How can they bring lower income customers back? And then in the middle, what we're also seeing is that in the most recent sales data report in the United States, what we've seen is that Americans are starting to pull back on their spending. Why are they doing that? Well, it could be because they're facing the impacts of the higher interest rates. They're facing the impact of the higher inflation. They're facing the impact of the higher cost of living. Now, this is something that I've been talking about for a number of months now, where if people are spending money, the economy is fine. But the problem that has been happening for the last number of months is people have been spending faster than they've been growing their incomes. And that's fine in the short term because you can put money on your credit card, you can dig into your savings, you can dig into your 401k, you can dig into your home equity, which I don't recommend you do, but that keeps the economy going. And that's kind of what's been happening. But now maybe, we don't know for sure, maybe that might be starting to shift. And what this means for you is, as an investor, you want to make sure that you can win when markets are up and when they're down. Because what I don't want you to try to get into is get into the game of trying to predict what's going to happen in the economy. Nobody can predict what's going to happen in the economy tomorrow, let alone next year, let alone 10 years from now. And I don't want you to get into the game of trying to predict that. Are there issues in the economy? Absolutely. Have there ever been a time when there weren't issues in the economy? No, that's always been the case. And so what you want to do now as an investor is understand what's happening. You want to understand the financial trends. You want to know what's happening because that helps you be a more savvy investor. But then you don't want to make investment decisions based off of emotion. You want to make decisions based off of financial education. And this is where now, once you start to absorb this, you want to make sure that you have a system that can allow you to win whether the markets are up and whether the markets are down. That means you have to know how to invest your money because guess what? The savviest and smartest investors know how to win in strong economies and weak economies. Weak economies, market downturns create opportunities for you to buy. Strong economies, market upturns create opportunities for you to see your wealth grow. And they also create opportunities for you to buy if you know where to look. But that's why I want you to not chase trends and not chase emotions, but understand what's happening in the system. That way you can win in this economic system. Again, on May 21st, I'm hosting a live workshop to go deeper into all of this. So I'd love to have you there. All you have to do is register. I got the link for you down in the description. But this is where the key is. You got to be prepared and you got to be financially educated because we know that we will see a recession in the future. When will it happen? I have no idea. But what we know is we've seen a recession pretty much every decade for the last century. That's the fact. And so now, if you think that the markets are only going to go up, you're setting yourself up for disaster. Now, that doesn't mean that we're going to see a recession tomorrow, But eventually we will. We don't know if it's going to happen next month, next year, or 5 years from now, or 10 years from now. But you want to do is prepare. That way you can make money as markets go up, but also make money as markets go down. And that's where the financial education comes into play. Unless and until Americans run out of money, people are going to keep paying the higher prices and companies are going to keep raising the prices very quickly. And that's why he says that Americans have to essentially run out of money in order for inflation to cool down. And that's why inflation is not cooling down, because Americans still have so much money. Until America is broke, inflation is still going to be a problem.